100 shares, you're basically buying 2 contracts. If you're buying 300 shares, you're buying 3 contracts. If you're buying 400 shares, you're buying 4 contracts. But it all depends on how many. You can buy 10 contracts, which would be 1,000 shares. You can buy 20 contracts, which would be 2,000 shares of that company. So you can put a little bit of money to control a whole lot of shares, right? And then when it goes your direction, you get the returns back without even owning the shares. It's a whole different play, right? But look at this, right? So let's say it's basically telling you Apple is at 130.73. I think it's going up, right? So these are your options. These are the expiration dates. So the expiration dates, it goes all the way to June 20th, 2025, right? These are the expiration date. So you can do an expiration date of January 20th. It's typically on Fridays, right? So you can do January 20th, January 27th, February 3rd, but you will notice that the further away it goes, the higher the premiums. The premium here is what you will pay for the owner, for the person that is going to sell you that 100 shares of Apple. You're going to pay them $5.68 per share instead of this, right? Y'all picking up what I'm putting down? You will pay them $5.68 per share. You can pay them $5.68 per share instead of $173 per share. So you understand the discount, the magnitude of the discount you are getting, right? So because you are purchasing in 100 blocks or whatever, 100 packs or whatever, it will cost you right? It will cost you 570. It will cost you $570. So instead of $13,000, you get to control $13,000 worth of Apple shares at $570. You picking up what I'm putting down? So let's say, let me go here and explain further. So let's say we buy, so this is the current price, right? This is the current price. This is the current price. You see that? This is the strike price. Strike price. Strike price. Strike price. Strike price. So you can say that I'm buying right now, but this is my strike price. So this is what the market has to exceed, because when you buy a call, you're predicting that the market is going to go up. So you can say I'm buying the 131 call, which means by February 10th, you're predicting that Apple is going to be at least higher than 131. And if it goes higher than 131, you make money. You understand? You can also choose 133, right? But you notice that the higher the strike price, the lower the premium. The premium here is what you pay to the seller. This is what the seller charges you to control the 100 shares. Because remember, the seller already bought those 100 shares, right? And they are loaning it to you so that you can buy it. You can buy it here. So when it expires, let's say this is how you can potentially make a whole lot of money. And that's what a call means. So if you buy a 131 call, right, and it gets to, let's say, 131 call, the seller makes money because they know or they think that Apple is not going to go above this. So you pay them a premium, and if Apple doesn't go above this, you lose the premium, they keep the premium, and they keep their shares, right? But if Apple goes to, let's say, 135, right, they are now obligated. They are now obligated to sell you 100 shares at 131, even though Apple is right here at 135. Do you understand that? So you get the right or the option to purchase at 131 for something that is at 135. If you want to own Apple. Does that make sense? So you can use options to make money, but you can also use options to get into stocks that you want to own at a much, much cheaper price. You can do that by using puts, right? You can use that by using puts to buy a stock, like when the market is going down. Let's say Apple is going down, and you want to own the shares, but you like, you know what? I want to buy it much, much cheaper. You can use puts, but I don't want to confuse y'all so far. Okay, so here, if you were to buy, and this is what I'm saying, this is what most people are accustomed to doing, buying. So let's say you're predicting that, okay, Apple